Hello and welcome back to Volatility 411. I'm Kevin Davitt, part of SIBO's Options Institute, and it's Monday, April 4th. Last week, the S&P 500 ended essentially unchanged, but realized and implied volatility levels continued to decline. The spread between 30-day historical volatility and at-the-money SPX options that expire in 30 calendar days is unusually wide. 1 month realized vols are around 22.5%. The at-the-money options that expire in early May are trading with an implied volatility of around 16.5%. Typically, those two measures are closer to one another, but the SPX options market is arguably expecting future realized volatility to be lower in the coming weeks. That dynamic is in part a result of the perception that the conflict in Ukraine may be cooling. This morning, the VIX index is measuring right around 20 even. The spread between the April and May VIX futures is out to nearly 2 handles wide. The standard April VIX futures and options still have more than 2 weeks until expiration on the 20th of this month. Now, the 22 strike in April VIX is the at the money, and the straddle is currently worth about 440, which implies a range of 1760 to 2640 over the next few weeks. Earnings season will begin next week, with most of the biggest banks reporting between the 14th and 15th. So, we're accustomed to keeping our eyes on geopolitical headlines. Earnings are now on the horizon, and the VIX futures curve is back in a fairly steep contango. That's Volatility 411 for Monday. Thank you very much for tuning in.